Welcome to the Deep Dive. Today we're tackling stablecoins. The digital assets pegged to things like the US dollar, meant to hold their value.
Exactly. And to really get our heads around this, we've gathered quite a bit of material you sent over.
We sure have. We're looking at stuff from Consumer Reports, some analysis from Brookings, the American Bankers Association's take, legal perspectives from Paul Hastings, Sullivan, and Cromwell.
And also Dinsmore, plus news coverage from CBS, Straight Arrow News, PYMNTS.com, and even Senator Warren's floor remarks. It's a real mix.
It is. So our mission, based on what you shared, is to unpack what these stablecoins actually are, look at this new legislative effort, the Genius Act.
Right, what it's trying to do, what the arguments, and frankly, the worries are around it.
And sort of what it all might mean for the future of digital money.
Yeah.
You're clearly trying to navigate this whole landscape.
Yeah, makes sense. It's complicated. Okay, let's dive in.
So maybe start at square one. What exactly is a stablecoin, in simple terms?
Well, the basic idea, and you see this in sources like Coinbase and Senator Warren's comments, is it's a type of cryptocurrency built to keep a stable value. Usually that means pegging it to something like the US dollar. So one coin aims to equal $1.
Okay, so the goal is stability. And people expect to be able to cash them out for real dollars easily and use them for payments.
That's the intention, yeah. Senator Warren mentioned that holders should be able to redeem them on demand, and they're meant for payments.
She compared them to bank deposits, but with a catch, right?
Exactly. She said they're like bank deposits in some ways, but, and this is crucial, they generally don't have that FDIC insurance backing that traditional U.S. bank deposits do.
Ah, okay. Which naturally leads to the whole regulation question.
Yeah.
If they act like money.
Then maybe they need similar rules. Yeah, and that's where this Genius Act comes into play.
The Guiding and Establishing National Innovation for U.S. Stablecoins of 2025. Quite a name.
A bit of a mouthful, yeah. But its core purpose, mentioned across, Consumer Reports, Brookings, ABA, the law firms, PMNTS, is to set up a federal regulatory system specifically for stablecoins. There's a clear push for some kind of framework.
So what are the key parts of this proposed framework? What does the Genius Act actually try to do?
Well, based on summaries like from Paul Hastings and Sullivan and Cromwell, first it defines what a payment stablecoin is. Think digital asset used for payments designed to hold its value against a fiat currency like the dollar.
And it specifically leaves some things out.
Right. It excludes actual national currencies, obviously regular bank deposits, and interestingly, digital assets that promise you yield or interest.
No interest. Why is that significant?
Well, Brookings and the ABA both flagged this prohibition on interest. The thinking seems to be to keep stablecoins focused on payments, not as direct competitors to savings accounts offering yield. It kind of keeps them in their lane, maybe?
Gotcha. So who gets to issue these things under the Act?
They'd be called Permitted Payment Stablecoin Issuers, or PPSIs. This could be a subsidiary of a regular bank, an insured one, or even an uninsured depository institution, or potentially a non-bank company that meets the requirements.
And who regulates them? Is it federal, state, or both?
It could be either, or a mix. Dinsmore's analysis points out it depends on size. If an issuer has over $10 billion in stablecoins out there, they likely fall under federal oversight. Fed, OCC, FinCEN. Under that, state regulation could apply if the state system gets certified.
Okay, back to the stable part. How does the Act ensure they actually are stable? What about the backing?
That's fundamental. Brookings, Dinsmore, Straight Arrow News, they all emphasize the one-to-one reserve requirement. For every stablecoin, there must be an equivalent value in reserves, like actual US dollars, treasury bills, really safe liquid stuff.
So real assets behind the digital token, not just trust.
That's the goal. And Brookings adds these reserves must be kept separate, segregated from the issuer's other funds, and they should get priority if the issuer goes bankrupt. That's meant to protect the holders.
How do we know the reserves are really there? Transparency.
Yeah, the Act mandates monthly reports on what's in the reserves. Sullivan and Cromwell and PYMNTS note these have to be checked by an independent accounting firm and signed off by the issuer's CEO and CFO. So, accountability.
And beyond reserves, are there other operational rules for these issuers?
Oh, yeah. Capital requirements, liquidity rules, risk management standards. The federal banking agencies would set joint regulations for these according to Brookings and Sullivan and Cromwell. Standard financial stuff, basically.
What about the risk of these being used for, shady purposes, money laundering?
Definitely a concern. The Act includes AML-CFT rules, anti-money laundering, and countering financing of terrorism. Brookings, ABA, Paul Hastings, Straight Arrow, PYMNTS all mention this. Issuers would have to monitor for and report suspicious activity.
So they need systems for that. And what if law enforcement needs to act?
The ABA points out issuers need the capability to freeze or even burn, essentially destroy stablecoins under legal orders.
And just to reiterate, still no FDIC insurance test.
Correct. The ABA, Straight Arrow, Dinsmore all make that clear. Payment stablecoins under this act wouldn't be FDIC insured. Big difference from a bank deposit.
You mentioned state regulation potentially playing a role. How does that work with the federal stuff?
Paul Hastings mentions this Stablecoin Certification Review Committee. Its job would be to see if a state's regulatory system for stablecoins is up to snuff with the federal standards in the Genius Act.
And can just anyone start issuing these?
No, the act prohibits unpermitted issuance. And Paul Hastings notes it also sets conditions for foreign stablecoin issuers wanting to operate in the U.S.
How does the act classify these things? Are they securities, like stocks, or commodities?
That's a big one for the crypto world. Sullivan and Cromwell highlights that payment stablecoins from these permitted issuers would explicitly not be treated as securities or commodities under federal law. That simplifies things from a regulatory perspective, potentially.
And if an issuer fails, goes belly up.
The ABA and Sullivan and Cromwell mention a specific resolution process in the Act, separate from normal Chapter 11 bankruptcy. It's designed to handle stablecoin issuer insolvency potentially more smoothly and protect holders better.
Okay, so the Genius Act is trying to build a whole regulatory house for stablecoins. But it sounds like not everyone loves the blueprints. What are the big worries?
You got it. Lots of debate. Consumer Reports, for instance, they want regulation, but they argue the current Genius Act needs to be tougher on consumer protection. Senator Warren and Straight Arrow News echo that, worrying it doesn't go far enough to safeguard users.
What about the banks, the traditional players?
The American Bankers Association, the ABA, they have what they call fundamental concerns. They worry about inconsistent regulation and supervision, especially for non-bank issuers. And like Senator Warren, they question if the bill really handles the risk of an issuer failing.
Financial stability is a big theme now.
Huge. Senator Warren explicitly warned about potential meltdowns if the safeguards aren't strong enough.
And national security. Any red flags there?
Yes. Both the ABA and Senator Warren raised alarms about whether the Bank Secrecy Act is applied strongly enough, fearing loopholes for illicit finance. Senator Warren actually stated that stablecoins are already a big part of illegal crypto flows.
There was also talk about who controls these issuers, especially non-bank ones.
Right. The ADA worries about the influence of parent companies and affiliates of non-bank issuers. And Brookings chimed in on the risk of too much economic power concentrating if stablecoin issuers get tied up with big commercial companies.
The ABA mentioned this principle. Same activity, same risk, same regulation. How does that apply here?
Their argument is the Genius Act doesn't fully live up to that. They think if stablecoin issuers are doing bank-like things, they should face bank-like regulation, especially the big ones.
Now, things seem to get pretty heated around potential political influence, particularly with Senator Warren's comments.
Yes. Senator Warren and some other Democrats raised serious concerns about potential conflicts of interest, focusing specifically on President Trump and his family's involvement with stablecoins, like the USD1 token.
Can you unpack that a bit? What specifically was raised?
Well, Senator Warren contrasted President Trump's earlier criticisms of crypto, calling it volatile, linked to crime, with a more supportive stance after the 2024 election, which followed significant crypto industry campaign donations.
And the connection to the Genius Act.
The timing was highlighted. The launch of Trump's meme coin and then his family's USD1 stablecoin by World Liberty Financial happened shortly after the Genius Act started moving through committee. Senator Warren pointed to USD1's fast growth and reports suggesting links between these ventures and policy discussions.
Didn't an international investment also come up?
It did. An investment by an Abu Dhabi firm, MGX, into the crypto exchange Binance, using Trump's USD1 stablecoin. Senator Warren, CBS News, Straight Arrow, they flagged MGX's ties and Trump's known business dealings in the UAE, raising questions about potential influence or even bribery concerns.
So the argument is the act, as written, might unintentionally help these specific ventures without enough checks.
That's the core of that particular criticism. Senator Warren suggests the current bill could boost the market in ways that benefit connected individuals, without tight enough rules against self-dealing by officials. This led to proposals from Democrats to ban elected officials and their families from being involved in stablecoin businesses.
Beyond that specific issue, were there other structural concerns? like big tech.
Yes, Senator Warren and PYM-NTS mentioned worries that the bill might open the door for major tech companies to issue stablecoins, leading to, potential concentration issues and competition concerns for the dollar itself.
And even with the act aiming for clarity, are there still fuzzy areas in the regulatory picture?
The ABA felt the role of FinCEN, the Financial Crimes Unit, wasn't fully addressed, maybe other regulators too. And while the industry wants clarity, as PYM-NTS notes, this act might not solve all the ambiguities.
What about that $10 billion threshold for federal oversight? Is that controversial?
It's definitely a discussion point where exactly to draw that line between state and federal primary oversight. Paul Hastings and Dinsmore noted that along with the whole state certification process, it's something being debated.
And we know a Senate vote didn't pass recently.
Correct. Paul Hastings, CBS Straight Arrow, reported a procedural vote failed, mostly due to Democratic opposition reflecting many of these concerns we've discussed. But reports also say negotiations are still happening to find a compromise.
So despite the pushback, there is still momentum for some kind of regulation.
Seems so. The crypto industry itself generally wants rules of the road, according to PYM-NTS, and sources like Sullivan and Cromwell and Straight Arrow indicate the Trump administration supports legislation to keep the U.S. competitive in digital finance.
And even banks are exploring this space now.
Yeah, Dinsmore points out banks are looking at setting up their own stablecoin operations or partnering with issuers. That tells you something about where they think things might be heading.
How does the U.S. situation compare globally?
Well, PYM-NTS notes other places, like the EU with its MiCA regulation, are already ahead in setting up comprehensive rules. So there's some pressure on the U.S. not to fall behind.
So, wrapping up this section.
Yeah.
Okay. A lot is still up in the air, isn't it?
That's fair to say. The failed vote slowed things down, but the conversation isn't over. Paul Hastings and CBS suggest there's still interest in finding a way forward. The original goal of getting something done before the August recess seems unlikely now, but the topic remains active. There was even that oddball suggestion about crypto ATMs in federal buildings. It just shows how much is in flux.
So, thinking about all this, what does it mean for you, our listener? This whole debate around stablecoins and the Genius Act really shows this tricky balance policymakers face. How do you encourage financial innovation but also protect people, protect the financial system, and deal with security and ethical worries?
Yeah, and the strong opposition, especially citing those potential conflicts of interest and fears about weak safeguards, it suggests the current bill likely needs some major changes to pass. And given how fast digital assets move, this whole story is far from finished.
Which leaves us with a final thought for you to consider. If stablecoins do become widespread, potentially reshaping how we make payments, but the regulations aren't quite robust or impartial enough due to these ongoing political fights, what could that future actually look like? What kind of unintended consequences, good or bad, might we not be seeing yet?